Hi, everybody. I am Chris from Next Step Insurance, and I'm here to talk about the marketplace, tax credits, and how that might affect your income and your health insurance. Let me share my screen here. So in 2020, Next Step was created by myself and my business partner, Kevin Stifel. We merged the insurance companies and the agents that were under Insurance Solutions. So we're actually not a new company because Insurance Solutions was started in 2013 by Dorcas and Paulette Rominski. Dorcas George is my mother, and she worked with Medicare, and Paulette was working with the marketplace. She was there when the Affordable Care Act was passed and was excited to start going. So I came in the fall of 2013, and it's been nonstop since then. I've kind of become known as an expert in the marketplace because I just love it. I have worked it and played around with it and found all the little tricks to get the marketplace to do what it's supposed to do. Next Step Insurance has 4 agents. We have over 2,041 current marketplace clients and 2,248 Medicare clients. So this is my whole team. I'm really proud of my company here. We're missing a couple of people, but we now have 15 people, all dedicated to health insurance, medical, Medicare, and more to help you with all those next steps in your life. So this session, we're going to help you understand the marketplace. What does that mean? The exchange, the income requirements, what is counted as income, the changes in the rules that happened for this year as well as next year. Understand how those tax credits are calculated, and then I want you to understand what qualifies as an HSA and what does not. So the health insurance marketplace was originally started as the Patient Protection and Healthcare Law of 2010. It was amended by the Healthcare and Education Reconciliation Act of 2010 and are now called the Affordable Care Act, sometimes referred to as Obamacare, though that really isn't a thing. That is just a nickname. The Affordable Care Act went live in 2014 with enrollment starting in 2013 in the fall. And I was right there with that first website. Boy, was it horrible. But the marketplace and the Affordable Care Act had promise. It has guaranteed coverage. There is no more pre-existing. So I still have people worried, hey, I'm going through some treatments. Am I going to be covered? Yes, you are. You can be in treatment one day with one plan and continue your treatment the next day with the next plan. There's no rate ups, so males and females are charged the same, and there's a significant, they controlled how much they would rate up for elderly people. And then there's no lifetime maximum, so it's just unlimited. I remember when it used to say $1 million. It doesn't say that anymore. If you cost them $1 million, that insurance company will still continue to pay, and not only will they, when you change carriers, they will as well. So there is no more worry about being an organ transplant or unfortunate cancer that just goes on and costs a lot of money. The insurance will keep covering you. The marketplace is just a place where individuals and family health plans can be purchased directly with the insurance carrier. And it's a great place to compare. I mean, I love the marketplace because I can see side by side the different insurance plans. And remember, it's not government insurance. That's what Medicare is. And I doubt very many of you would want Medicare to disappear. So it is not government insurance. It's just really more government regulated insurance. So who is eligible to go on the marketplace? Well, technically everybody is eligible to go on the marketplace, but only certain people can get tax credits to reduce the cost. So the ages anywhere from 0 to 64, adult children no longer eligible for their parents' plan. They can come on. When your job doesn't offer health insurance, maybe you're between employment. If you lose coverage, whether it's voluntary because you're retired or you quit, or involuntary because you were laid off or fired, it doesn't matter. If you had employer coverage and you lost it, you can sign up. Early retirees, 55 to 64, let me tell you, not retiring because of health insurance is no longer something you have to worry about. It's very affordable. And those who are not over 65, but not eligible for Medicare. So that would be somebody who maybe an immigrant who moved in too late to put enough money away into their Medicare Social Security account. So what exactly are marketplace tax credits? Well, the tax credits are paid from the federal government directly to the insurance carrier to help lower your monthly premiums. So they're substituting an employer helping you pay for your premium. It's truly a tax credit. It's not a subsidy. I'm not really sure where the word subsidy started coming from, but it's a tax credit, just like a child tax credit. And I'm sure everybody who has more than one child takes every child tax credit that you can get. So what are they looking for? They need the MAGI. That's the income we need, the MAGI. And I know, what the heck is the MAGI? Or tell me what line it is. So the MAGI stands for Modified Adjusted Gross Income. So not the MAGI that came from the East. It's the modified adjusted gross. And the sad thing is, it's not a line that I can just tell you on your tax form. So how that works is you have to figure out what your adjusted gross income is. So that includes your taxable income, wages, pensions, Social Security amounts, rental income, annuities, withdrawals from your IRA or other kind of savings accounts. Something that you have to tell the IRS is your income. Then you can deduct things like rental expenses if you own rental property, moving expenses, IRA contributions. You can put that in. As you can see, student loan interest is also a deduction. And if you're self-employed, your business expenses. So that's how you get your adjusted gross income. The MAGI is other income. So that's what kind of gets people messed up. I love how they just write other. So that other income that we're talking about is the non-taxable Social Security. That is what we need. So not everybody pays taxes on your Social Security. Some do, some don't. Sometimes it's a partial. I leave that to the accountants, but that's why we ask for gross Social Security. So how do you find that? Well, it's on your, there isn't a line item. So I'm going to walk you through it. You take your, this last year's 1040, you look at line 11. That is your adjusted gross income. So most of us, if you don't collect Social Security, that's all I need. That's your modified adjusted gross as well as your adjusted gross. So most often they match. If you do collect Social Security, you need to look at line 6A. That is what your gross Social Security is. Then look over across the way at line 6B. That's your taxable Social Security. And that can change. I can see it match 100% the same or nothing. Somebody gets none of their Social Security taxed or partial. Again, I'm not sure why, that's an accountant arena, but that's what we're looking for. So to find out what your MAGI is, you're going to take line 11, $30,000. You're going to subtract the $805, and then you add back the full Social Security, $15,362 in this example. So their modified adjusted gross is $44,557. So their gross on the line item, $30,000. If you put that in the application, when you file your income tax, the IRS says it's not $30,000, it's $44,557. And that's where I know many people have gotten hung up. So remember, it's your gross Social Security. Don't subtract if there's Medicare payments coming off. You have to do gross. So now changes to the Affordable Care Act now and that continue into next year. There were 3 really big changes that happened. The first one, no more income cliff. Oh, I hope they keep this one. Anyone whose insurance options are more than 8.5% of your income will get a tax credit. So it doesn't matter where your income is, you get one if that insurance is going to cost you more than 8.5. The tax credit amount was increased. So that means the government is going to pay even more and you pay even less. So it's very nice. For 2021 only, any primary adult in the house who received at least 1 week of unemployment, your entire household is reduced income down to the 101% poverty level. So what that means is if you're a single person, you collected 1 week of unemployment, regardless of where your income is, they're basically going to say it's like you made 13,000. If you're married, you made 18,000. Even if you made 40,000 or 70,000, the marketplace is going to calculate it at 13. Now you still have to pay your taxes on what you truly made, but you won't have to change or make adjustments to how much you paid for your premium. So the top 2, they're only good for 2021 and 2022. As of right now, Congress is arguing about whether to continue that lack of income cliff or let it come back in 2023. So little politics, make sure you contact your congressmen and Congress ladies and let them know you want that to not come back. We want to keep it the way it is right now. So who is eligible for that premium tax credit? I used to have to do this. I used to have to tell you exactly where your income had to stay under. No more, at least for 1 more year. So anyone whose insurance options are going to cost more than 8.5% of the household income will qualify for a tax credit, regardless of income. So it's still based on household income, not just the person getting it, it's everybody who's reporting income. There's no income brackets, so you can't call me and say, how much can I make before it changes? It's a percentage. So if you want to figure that out, just figure out, if I pull money out, what's 8.5%? Can I afford that? The calculation is based on the second cheapest silver plan in the county, based on the statistics of your age and your family's age. If the rate of that plan is more than 8.5% of your modified adjusted gross, you'll get tax credit. But if the plan is already less than 8.5%, you won't get tax credit. Somebody in their 30s making 100,000 is not going to get tax credit, but somebody in their 60s, because their plans cost more, will get tax credit. So that's actually quite fair, in my opinion. Everybody's paying roughly 8.5%. If you make more, you pay more. If you make less, you pay less. So what's that look like? So I'm going to do some calculations just so you can kind of see what that looks like. So couples age 63 and 62, their income 45,000. So that family would qualify for a tax credit of 1,844 here in Sheboygan County. It does change by county. So the bronze plan would cost them nothing. That silver plan would cost around 166, and the gold plan 461. That silver plan is that 8.5% at 166. Well, what if their income was at 65,000? So now the tax credit went up or went down, so they have to pay more. So it went down to 1,581. So the bronze isn't zero anymore, it's 59 bucks. The silver's 429, and that gold plan 724. What if you make $20,000 more than that? So if you made 85, now your tax credit is 1,409. The silver plan is 601. That's that silver that they do that calculation. There's 10%, or sorry, 8.5% of your income. So that's a pretty big savings. That's $16,000, over $16,000 of savings, even if you're making an income of 85,000. So obviously, the less you make, even bigger savings. Now, one of the weird ones, if that couple has a 63-year-old and a spouse on Medicare, same income at 65,000, your tax credit's only $590 a month. But if you look, that silver plan, still 429, exactly the same as it was before. See, look at that, exact same, $429, whether there was two people on the plan or one. So remember, the IRS, they just do numbers. They're just doing a percentage. They're going to make it 8.5%. So here's my really rough calculation. Income at 65,000, 8% of that is 5,525 divided by 12 equals roughly $460 a month. So the tax credit is applied to make the second cheapest plan cost $460 a month, regardless of how many people are on the plan. Remember, the IRS is about percentages. It's not prorated. They've never prorated anything. And I'll show you babies, right? They don't prorate. A baby born on December 31st, same tax credit as a baby born on January 1st. So remember, we're dealing with the IRS. And while it may not seem quite right, it is fair, and it's just 8.5%. So there will always be bronze plans that cost less than that 8.5%. There's gold plans that will cost more. There's always one cheaper silver plan, because remember, it's based on the second cheapest plan. And of course, there's numerous more expensive silver plans. So that's where that comes from. If you're trying to think of the future, how much can I afford for my health insurance? It's a pretty easy calculation. And if you're really healthy, you're not even probably going to pay 8.5. You'll probably end up in a bronze plan. So the fine print, we do read this every time. Sometimes we do a little rough, we kind of edit it for you, but here's the fine print. At the end of the application for the tax credit, It says, I understand that because the premium tax credit will be paid on my behalf to reduce the cost of health coverage for myself and or my dependents, I must file federal income tax for that tax year. And if I'm married at the end of the year, I must file joint income tax. They're not going to let one spouse make 100,000 and one be a stay home and say that's not how it works. You have to file together. Now, if you are legally separated, you are in the process of getting a divorce, or maybe you separated a long time ago and never actually officially got divorced, you can file separately. The other fine print, no one's going to claim you as a dependent. That's very important. You'll also claim a personal exemption deduction on my federal income tax return for any individual listed on this application as my dependent who is enrolled in coverage through the marketplace and whose premium for coverage is paid in whole or in part by advance payments of the premium tax credit. So make sure you know who is and is not a tax dependent. Just because your son or daughter's living with you, if they have a full-time job in their 20s, they're not a tax dependent. So please, if you're not sure, talk to your tax accountant. I know people that have had mothers that live with them that are tax dependents. So that's fine. We're going to rely on you to tell us the correct information, and that's what we're going to put in. And lastly, I understand it may impact my ability to get premium tax credits if any of those things change. I also understand that when I file my federal income tax return, the IRS will compare the income on my tax return with the income on this application. I understand that if my income on my tax return is lower than the amount of income on my application, I may be eligible to get additional premium tax credit amount. On the other hand, if the income on my tax return is higher than the amount of the income on my application, I may owe additional federal income tax. That's what we're talking about. On the other hand, if your income is higher, you're going to have to pay some money back. So what does that look like? So our couple, again, age 63 and 62, with that application, they put $65,000. So it was calculated they would have a $1,581 a month tax credit. But when they report their income, they actually made $85,000. Well, that's $20,000 more than was on the application. So the IRS goes, well, we were paying $1,581. We should have been paying $1,409. The difference of $172 a month. So the couple has to pay back $2,064 if they used it for the whole year. So you're paying back $172 per month that you used it. If it was only 2 months, it's only for 2 months, not for a whole year. It's not a penalty. This is you paying back what the IRS overpaid for you because you said your income was lower. If you report the income to the IRS at $155,000, or this couple, the tax credit should have only been $913, not $1,581. So this is a big difference of $668 a month. The couple's going to have to pay back $8,016, but they still saved $913 a month. So it's what you would have been paying each month if you had reported that higher income. So that's what it is. It's not a penalty. You're just paying back in a lump sum what was paid on your behalf. Now the reverse, if you say your income is higher and it turns out it's lower, you get tax credits. So same couple, they said they were going to make 65. They actually made 45,000. The tax credit should have been 1,844. Basically, the couple paid $263 a month more than they should have, so you get that back. If you report income at $25,000, now they're going to say, whoa, your income you were paying $430 a month more than you should have, you'll get that back. Now, if you were only paying $200 a month, you're not going to get $400 a month back. You're only going to get that difference. And if you are already paying zero, again, you're not going to get any more money back. You're already at the least expensive plan you could be at. So income matters, right? The lower incomes also have a little extra. So this is where the IRS isn't necessarily fair and it's just a calculation, but the Affordable Care Act is. So they built in a bonus benefit called cost sharing reductions. They're only available in silver plans. So if you see that silver plan, don't think, ooh, a gold must be even better. Nope, it's only in the silver plans. So the silver plans are reducing the cost excuse me, of the out of pocket. So your copays, your deductibles, your max out of pocket for people whose income falls between 100 and 250% above the federal poverty level. When they made the Affordable Care Act, they said, okay, somebody who's making 13,000, it's great that their premium is low, but it's not going to help them if their max out of pocket's $8,000. So the insurance companies had to come in with these lower cost sharing reductions based on where the income was, so that not only was the premium affordable, but the insurance itself, the copays, deductibles were also affordable. So this is what it looks like. So here we have somebody living in Sheboygan County, 58-year-old female, making $31,900. Their savings for that tax credit, $774. If I move their income by $1, $31,901, they no longer qualify for that cost sharing reduction. So see up there on the top, it says CSR in yellow. That means that plan has cost sharing reductions and the other one does not. So this is what that looks like. Look at that deductible, $3,300 versus $7,000. Exact same plan, but the difference was how much income was reported. And if you look over on the side, the premium amount, not a big difference. The copays are less. Instead of a $60, it's $40 at a primary. So that's a big thing to be paying attention to. If you're only a couple bucks up, it can make a big difference. The next little bracket is if somebody's making $25,520 versus $25,521. So again, as you can see, the cost sharing reductions are on both these plans. The tax credit's $837 for both of them. So what does that look like? Well, the premium is $0, but look at that deductible difference, $3,300 or $400 deductible. A max out of pocket that goes from $68,000 to $2,850. So pretty big difference. That's why we really want to know what your income is, why we ask questions to make sure you're in the right bracket. There's one more bracket. So same person, all I'm doing is changing the income from $19,141 or $19,140. Tax credit again, exactly the same. And since we already know the premium was $0 with a higher income, we know the premium is going to be $0 for here. Deductible $400 down to $50. Max out of pocket $2,850 down to $1,500. So we are partly why we are so careful about asking your income and finding out where you are. Because if you're right at that 150, we'll just keep you there. We're not going to put you up by $100 and all of a sudden your deductible jumps. I know some of you are wondering, if you go over the income listed on the application, you have to pay back the IRS. You don't have to pay back the cost sharing reductions. The insurance company does not go back and find out what your taxes were. Only the IRS wants their money. So that's what those cost sharing reductions benefits are. And now HSAs. I want to explain that a little bit. So there's some misunderstanding of what an HSA is. So an HSA is a health savings account. It's something you can just open at your bank, or if you have one through your employer, they're basically have the bank account for you. It's a tax-free savings account that can be used to pay for medical expenses not covered by a high deductible health plan. So a health savings account benefits, it's tax-free money. You helps pay for qualified medical expenses like your copays, deductibles, helps pay for most of your Medicare premiums. So any money in that account when you turn 65, you can use to pay for your premiums. And it can grow a nest egg because it is tax-free money. It's wonderful. And if you start when you're young and you just start putting away 20 bucks a week into there, by the time you need it, you could have significant savings in there of tax-free money and never have to pay for medical with money that you have to pay taxes on. So in order to be a HSA qualified plan, that's kind of the big thing. Some accountants may tell you, oh, just go contribute. You had a high deductible plan. Make sure you have to be enrolled in a qualifying high deductible plan. The IRS is not going to give you money tax-free without having some restrictions on it, some rules and regulations. So you must be enrolled on the first day of the month. You can't have any other health insurance. You cannot be on Medicare, TRICARE, or TRICARE for Life, or the VA. So you can also be claimed as a dependent. and it must be a qualifying high deductible plan. The IRS is, they're making the rules. So what they say is there is a deductible that must be met before the insurance company pays anything other than preventatives. So your preventatives are still free, but everything else you are paying the full cost until you reach the deductible. Once that deductible is met, the rest of the costs are also a percentage, not a copay. So if you have a plan where you are paying a copay, any kind of copay, you go to the doctor, you pay $30. You go to the pharmacy, you pay $10. It is not a qualifying HSA plan. Though the nice thing about HSA plans are the max out of pocket is lower than your traditional bronze and silver plan. So I'm going to just do a side-by-side comparison here. So this is Prevea 360, local insurance company here in the northeast of Wisconsin. They offer a copay plan and a high deductible plan. So on the left, the high deductible plan is $807 a month and the copay is $780. No tax credit on this, just showing you the cost. The cost is very, very similar, but if you look at that deductible, $8,500 versus $6,000, that is a pretty significant difference. $6,850 versus $8,500. So that HSA has a significantly lower deductible. But if you look, they have copays on the right plan, no copays on the left plan. So if you go to the doctor in that HSA, you're just going to be charged whatever it is, whether it's $200 or $300. On the right plan, you're going to pay $60 and then you're done. So that's the difference. So again, they both have high deductible plans, but only one of them is a qualified plan. So if your accountant or tax advisor or financial person says, hey, you should open an HSA, please make sure you understand what that is. Now, when it makes sense to enroll in an HSA plan, maybe you're going to have surgery and you know you're going to reach that max out of pocket at the beginning of the year. You're going to have a hospital stay. Maybe you've got some treatments or extremely expensive medications. It might make sense to sign up for an HSA because then you can put money in the bank. It may just go in and out, but then that's tax-free, comes off of your taxes and you're paying your medical expenses right with tax-free money. And it's also less, $6,850 versus $8,500. And then you're free and clear for the rest of the year. Once you reach that max out of pocket, everything's 100% covered. Maybe you already have an HSA and you like it and you just want to keep contributing. You already have a pretty significant amount and you want to keep doing that. Maybe you're younger and you're healthy. It is a great way to save for the future and it's tax-free for life. You're self-employed. You're trying to reduce your expenses and your taxable income. And in the past, we would do HSAs to keep you under the income limit. We don't have to worry about that anymore, at least not for the next this year and next year. But again, if you want that income limit to stay gone forever, please contact your Congress people. So when it doesn't make sense to enroll in an HSA plan, as many of you know, Molina came out with a zero deductible bronze plan this year. It's kind of amazing. Yeah, even if Molina is not your favorite company, kind of hard to argue with a $30 copay for your doctor instead of, I don't know what the doctor bill is going to be, $200 or $300. Maybe you have lots of doctor's appointments, but you actually don't have anything major, no surgeries, no MRIs, not hospital stays, and you've never had an HSA before. And it really doesn't make sense to have an HSA, not when you've got those zero deductible plans. So key points to remember, ACA, the Affordable Care Act marketplace, is not government insurance. It just regulates the type of insurance coverage that can be offered. The marketplace is just a place to look for all the different health insurance options and compare them side by side. There's no more income cliff for 2021 or 2022. Know what your modified adjusted gross income is, and then understand the consequences of lower or higher income at tax time. Tax credits are based on the whole household, not just on the person enrolling. If your income on the application is lower than what's reported, the client will pay back the difference. If it's lower, the IRS will give you it. If it's higher, you're going to pay back the difference. And HSAs, they can be used as a tax deduction, but only if you're enrolled in an HSA qualified plan, not just a high deductible plan. You can run your own quotes if you would like. Often we will send that to somebody who really wants, who maybe they've got flexible income and they want to see the consequences of 20,000 versus 30. Here's the website. You go to healthsherpa.com/agent_ID equals Christina-George. That's just mine. If you want to sign up, you certainly can. I promise I'm not going to spam you. It's a great way to just do quotes. You put in your zip code, hit see plans and prices, then you enter ages and income, and then you can just see how the rates change. I'm happy to help, and I'd like to point out and remind everybody, there is no difference in your premium if you have an agent helping you or not. And believe me, it's nice to have an agent when you start having trouble with the insurance or when you start having questions. So it doesn't hurt to have an agent. And again, it doesn't cost you. It costs exactly the same whether you have an agent helping or not. So thank you. Please write any questions you have in the comments down below, and I will try and get back to you as soon as I can. You're also more than welcome to call the office at 920-268-1600 and talk to either myself or my assistant or any of the agents in the office. Thank you again for tuning in and checking out the website and the YouTube channel. And I hope you have a great day.